Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Okay, let's dive right in. We have to talk about the market dynamics around Eastern International Limited, that's ticker ELOG. Specifically, the high-velocity trading event that happened on December 24th.
It was pretty extraordinary.
Extraordinary is the word. The data from that one session, it's unprecedented for a stock this size. We saw a staggering 36.25 million shares trade hands. Now, to really understand what that means, you have to compare it to the company's available float. The public float is ultra low. It's sitting at roughly 1.6 million shares.
Right.
So that volume, it represents a turnover ratio of 22.6 times. The entire public float was exchanged in a single day.
Mm-hmm.
And this extreme velocity, it really forces a fundamental question on us, which is what we need to get into today. Is this volatility a reflection of a real successful material shift, the pivot into high-growth solar infrastructure? Or is the valuation just, an artifact of market structure and speculative momentum, a pump, in short?
Exactly.
I'm going to be arguing today that the fundamental catalyst here, that key solar contract, is precisely what justifies the market's intense attention and this re-rating.
And I'll be coming at it from a different angle. Look, I absolutely acknowledge the size and importance of that catalyst, of course. But I'll be arguing that the current valuation is, it's structurally unstable. It's functionally detached from the underlying financial reality. I think it's being driven purely by illiquidity, by speculative flows, and this price action is masking some severe, and I mean immediate, balance sheet weaknesses that make this valuation entirely unsustainable, regardless of the headlines.
Okay, so let's establish why this move was not just, desirable, but absolutely necessary for them. Before this pivot, ELOG's legacy logistics core was a textbook example of a stagnant business. We were seeing chronically low margins hovering around 4.4% net profit. And crucially, revenue wasn't just flat. It was showing a measurable negative 0.99% decrease in the trailing 12 months. So management was really facing obsolescence. They had to pivot. They had to find a growth story to attract capital.
No argument there.
So the material catalyst they got is the linchpin of their survival. They secured the Hebei Laiwan 300 megawatt solar project contract. This came through their Yangguizhou Tianram subsidiary. Phase 1 alone is valued at RMB 42.5 million, which, translates to about 6.04 million USD. And when you measure that against the company's TTM revenue, which is only around 40 to 46 million, that single phase represents about 15% of their annual revenue. It validates the pivot as a massive, tangible development. Furthermore, you're focused on the capital constraint, which is fair, but I think you're missing the strategic leverage here. This isn't a completely cold start for them. The logistics core already serviced, and I quote, new energy projects and special cargo logistics. They were literally the delivery service for massive solar components. So the shift from shipping the parts to installing them is the most logical, high-margin vertical integration you could ask for. They know the supply chain, they know the site demands, and now they can capture a much higher margin. This existing footprint, it gives them a huge competitive advantage that I think fully justifies the market's enthusiasm.
Okay, I acknowledge the contract is strategically logical. And yes, it's financially material in terms of top-line revenue management had to do something. But materiality does not dictate price stability, especially when you really look at the structure of the trade. I'm sorry, but I just don't buy that the price action we saw on December 24th was about fundamental, careful accumulation. When we see 22.6 times the entire public float exchange hands in a day, it tells us the stock is trading purely on momentum. It's driven by scarcity and the kind of exuberance, that's associated with the greater fool theory. And this enthusiasm ignores a critical financial reality, the balance sheet. In recent filings, the company's cash and cash equivalents are startlingly low. They're fluctuating between $1 and $1.5 million. Now, they've just secured a $6 million contract. Well, construction contracts demand significant upfront working capital.
We are talking about maybe $1 to $2 million needed just to get phase 1 rolling. The company simply does not have the cash on hand to do this. It is a critical liquidity trap. And therefore, this meteoric run-up isn't a stable re-rating. It's providing management a window to execute a necessary secondary equity offering. Dilution is a near certainty, and that certainty undermines the entire bullish case because the run-up is driven by a scarcity that the company itself is about to eliminate.
Well, that brings us directly to the quality of the contract versus the constraints of the balance sheet. And you're right that working capital is tight, but we have to look at who they are working for. I see why you think that the execution risk is the primary thing here, but let me offer a different perspective on that risk mitigation. The contract counterparty is a subsidiary of the China State Construction Engineering Corporation, or CSCEC. This is a massive, central state-owned enterprise, an SOE. This relationship minimizes credit risk almost entirely. The counterparty is backed by the state. They will not default. Beyond that security, landing this contract acts as a crucial seal of approval. It validates ELOG's technical credentials in this new sector. And let's look beyond Phase 1. This 50-megawatt phase is just part of a planned 300-megawatt project. The other 250-megawatt represents a massive blue sky opportunity, potentially another $30 million in revenue. If they execute, that pipeline would nearly double the company's annual revenue base to around $76 million. Given that, doesn't the potential reward justify the risk of a temporary working capital strain? The market is pricing in that massive future growth.
I'm not convinced by that line of reasoning because while the counterparty's credit risk is low, you're right, they won't disappear, the operational cash flow risk is extremely high. You are hanging your hat on a piece of paper that promises revenue, but revenue is not cash flow, especially not with SOEs. SOEs in China are notorious for lengthy payment terms. We're talking 6 to 12 months often, and they frequently rely on commercial acceptance bills, which require, additional steps and potential discounting to even turn into immediate cash. You're correct that ELOG will recognize revenue under what we call percentage of completion accounting. So for our listeners, this means the company can book profit on its income statement as soon as they hit certain milestones, even if they haven't received a penny in cash. The problem arises when you factor in that critical 1 to 2 million working capital requirement. They're forced to deploy millions upfront. They look profitable on paper, but the cash reimbursement only arrives months later. This is the definition of a growth squeeze. It's a situation where rapid top-line growth creates a severe cash crisis that can bankrupt an undercapitalized firm. Recognizing $6 million in revenue when you have $1.5 million in the bank is a terrifying mismatch.
That is a critical distinction. And I agree, the timing risk is palpable. However, in addressing that specific cash constraint, we have to circle back to the trading velocity. What if the massive volume isn't just retail mania, but the necessary precursor to solve the very liquidity problem you're identifying? The velocity event on the 24th fundamentally establishes a trading price that allows management to price a follow-on offering effectively. If we agree dilution is inevitable, is it better for the company to raise capital after a quiet week at $1 a share or after an explosive run-up that validates a price point near the recent highs? The volatility, therefore, it serves a function. It creates the visibility and the pricing window needed to fund the contract, which ultimately leads to that doubling of the revenue base.
That's an interesting point, though I would frame it differently. Let's move away from the theoretical need to raise capital and look at the actual evidence on the trading tape. If we assume your premise holds that sophisticated institutional investors were re-rating this company, shouldn't we have seen quiet, large-scale accumulation? Block trades that minimize market impact? Instead, we saw massive velocity, and the data shows high off-exchange or dark pool volume. Now, in this microcap context, that signature confirms the rally was overwhelmingly driven by retail internalization and order flow momentum. This is small, fragmented, aggressive retail orders being bundled. Institutional desks simply do not trade 22.6 times the float in a single day. This trading signature, high velocity, low float, and algorithmic scraping of keywords like solar, it points directly toward highly volatile meme potential, not fundamental institutional buying.
I acknowledge the retail signature and the volume, but I think you're misinterpreting the consequence of exhausting supply. You assume the volatility is purely speculative noise, whereas I would argue it is the sounds of supply drying up. We have to verify the structural integrity of the shares. The company has a clean cap table. There is zero history of reverse splits since its August 2025 IPO. This is not some legacy toxic corporate structure designed to just churn out shares. The massive trading volume simply shows that the fundamental news that 15% revenue catalyst plus the SOE validation was powerful enough to completely exhaust the available supply of shares. And when the float is this scarce and supply is gone, it inevitably creates what we call fluid pricing and massive volatility. This visibility is a necessary, albeit chaotic, step from microcaps to attract the kind of serious, longer-term capital needed to actually price a future offering. So the volatility is a symptom of fundamental validation meeting market scarcity.
But that validation, if we accept it, comes with an enormous governance risk that independent shareholders are powerless against. Have you considered the severe concentration of power here? ELOG is explicitly designated a controlled company under NASDAQ rules. This is because the CEO and chairman holds approximately 64.8% of the voting power. Now, for the audience, being a controlled company means ELOG is exempt from key governance requirements, like having a majority independent board. Independent shareholders have zero control over critical decisions. This includes the highly speculative pivot we're talking about, and critically, the timing and size of that inevitable secondary offering we both agree is coming. This concentration of power amplifies the dilution risk because management can sell shares into this run-up whenever it suits their capital needs, regardless of what minority investors think.
I see why you think that, but let me give you a different perspective on that. Sometimes, structural instability requires decisive, centralized action. Management, facing a failing business, chose to make a necessary high-stakes move that offers exceptionally high rewards. If management didn't have this concentrated voting power, the inertia of a dispersed board might have prevented this pivot entirely. And the longevity of the subsidiary Suju TC Link, it provides operational legitimacy. This is not some shell company cooked up overnight. The pivot, while yes, it's risky due to the capital constraint, provides the only credible path toward a potential doubling of revenues. And the speculative premium is justified by the fact that this high concentration of power allowed for an immediate, decisive, and ultimately necessary strategic shift.
And that tension between the undeniable fundamental upside and the immediate structural threats is precisely what defines this situation.
Indeed. So today, we've really dissected the core tension around Eastern International Ltd. On one side, we have the verifiable material shift from the new solar contract secured with a blue-chip SOE client, which fundamentally validates the company's pivot into a high-growth area. And this contract provides the only real path to doubling their revenue.
On the other hand, we are confronted by severe structural and financial headwinds. You have an ultra-low float that results in a destabilizing 22.6x turnover ratio, and that's coupled with a critically thin balance sheet. Their cash reserves are just not sufficient to fund the working capital needed. This severe financial mismatch suggests the run-up is primarily driven by scarcity and is really just providing a window for a highly likely and very large equity dilution.
CE contract and the potential pipeline that could double the revenue base, even acknowledging the steep execution risk.
And mine is that the current price is overwhelmingly a reflection of market structure scarcity and momentum psychology. Investors have to distinguish between booking revenue on paper and actually receiving cash, because the balance sheet suggests the next major catalyst won't be more revenue but a massive dilution event.
Ultimately, the story of ELOG perfectly illustrates the complex market mechanics of 2025. It's a microcap driven by liquidity flows, and it's trading far more on scarcity and sentiment than on traditional valuation metrics. The material is rich, and there is clearly much more to explore here as the situation develops.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.